You had mentioned earlier that there's something called as the sell liquidity happening at the gold area. So I just wanted to know what did you mean by that?
Okay, so if we take a look at gold, it happens on, and not only gold, it happens on any pair, any commodity, anything you trade in the market has liquidity. So think of it like retail, right? So when retail sells, they see that this here is a point of area, you could say resistance, because, you know, retail traders, they have the mentality of support and resistance, supply and demand trading, and they say that this is a resistance area. Now, that's just a fantasy mentality of a retail trader, that they think that this is a resistance area. Meanwhile, it is actually a point of liquidity for banks to come in to raid so that they can fill their orders. So when price creates something like this is a point of liquidity. And the same can be said for when price comes to the bottom over here, another point of liquidity or retail support is created, and those are points of liquidity, because based on the fact that for every buyer there's a seller, for every seller there's a buyer. So buyers meet sellers, sellers meet buyers. So retail is selling to the banks and buying from the banks, and vice versa. It's basically, we are trading in a transactional environment where we trade whatever we trade, commodities, stocks, indexes, cryptos, doesn't matter. Liquidity is created. That is the name of the game. We are the byproduct of Forex. Forex was not created for the retail trader. It was created to exchange monetary value and liquidity across borders, so to different countries or to nations. Or, you know, if Microsoft in China wants to buy USD to pay their employees, then they will sell yen to buy dollar, or buy dollar to sell yen. So you can think of it from a point where buyers meet sellers and people need to be paid in different currencies. And this is the whole, I can go to a whole bunch of macroeconomics, but that would be beyond the scope of what I'm teaching you here. But basically, every time that there is buyers and sellers, liquidity is created, and that liquidity is controlled by the market makers. And we are at the mercy of the market makers. So we can only trade as best as we know how to trade against the market makers. So these are the points of liquidity. So every time you see that there is lows created, you will notice that there is liquidity at those points. So the same can be said over here. So this is a 1 hour chart, okay? That's the liquidity on a 1 hour. Let's take a look at the 4 hour liquidity. There would be more because it's a higher time frame. So anytime that there is, this would be taught in another lesson I'll bring out, but here is a large point of liquidity because price came up to this level, bounced off of this level, rallied up to this level, and bounced off of this level. So retail now is putting their stops above here because this is now resistance for them. So again, here you can see that more liquidity is being created over here. You can see that price did not raid above. So if people put their, say, stop losses on this line over here, over there, their liquidity is still waiting to be raided, okay? Their stop losses are still safe, but at some point, the banks will push price beyond this, taking out the stop losses. So those people selling, the banks are buying from those sellers. You can think of it because there's sellers here, and when price goes up, they are buying from someone who's selling. So that is how the transaction works. And we can see that there's a fair value gap over here, price imbalance. So I'm just going to mark that up as a purple box so you can see that that is a fair value gap of imbalance in price over here on this area of the chart. You can see that this wick came in, closed some of this fair value. So this entire candle here was an imbalance in price. And if we measure this, let's just actually measure this, and we can see that this is probably around the 50% area where price came in. Okay, just a little bit more than 50%. Well, if we measure this whole candle, that's probably, yeah, 50%. You can see there is our 50% level of that candle right there. Price rallied into and closed below. So this is still for the taking, this fair value gap over here. So there's still fair value there. Not only is there fair value, there's also a 4-hour order block over here. So this is a 4-hour order block on gold. So this 4-hour order block has not been tested yet, meaning price hasn't even touched it yet. So when an order block is not tested, that makes it a good area to look for sells from, because gold will like to test that order block at some point, whether it comes in to wick off of it and close the fair value gap like that, or test at least the 50%, or even, because remember now there is liquidity sitting up top here, so they can even push price wicket, taking out the stops over there and then dropping price. Okay, because imagine this, so retail traders on a 4-hour chart are seeing, oh, look at this trend line that's being created here. Okay, so retail traders are going to be like, okay, well, when this trend line breaks, I'm going to sell. Okay, and what is the banks going to do is they, okay, well, there's our break in our trend line. Price is going to go down. I'm going to sell. Okay, what does banks do? Boom, price goes up, taking out all of those sellers. They are buying from those sellers, trapping them in this trend line, raiding this liquidity up top here, over here. So there's more liquidity over here. So all this liquidity gets raided, touches this order block over here, and we can see a potential move to the downside when we get to that area, or even raiding the stops up top here, because you can imagine how excited retail traders will get when price crosses the previous high. Oh, it's made a higher high. Obviously knowing that if it's made a higher high, price will at some point want to go higher. Well, there is some truth to that, but at the same point, price will probably go higher, but it's going to go lower first and then only go higher. Okay, so that is our market structure over here that is being created. Higher highs, lower lows. You see higher lows, sorry, higher highs and higher lows. So we can see that that sort of market structure is created not out of thin air, not by retail traders, but by banks buying and selling from other banks, institutions, retail traders. And obviously the banks and the institutions can see what retail traders see, obviously, because they can see that this is a trend line that is created here. And that is how the creation of liquidity is created. So let's just clean this chart up here quickly. And this would have been a point of liquidity over here. So when retail traders saw that there was resistance there, they sold. Again, more liquidity over here. Retail traders would have sold again, and price rallied down. Now price raided that liquidity over there, raided up, raided this liquidity over here. So that is no longer liquidity for the taking, because it is already now taken over there, taken again. Okay, and if we look on the daily chart, we can have a quick look here. Well, we can see that on gold, this order block here, there's an order block here, responsible for this move to the downside. And if we see here that price has not closed above that order block over there, so price is encapsulated inside of this order block. You can see this wick through, but wicks mean nothing. We want to see candle closes. So price wicked through, taken out some liquidity. Maybe there was some stops sitting at the top here of this area here. Price touched up above, clearing those stops. Boom, price rallied down, fooling retail traders into buying. So Sham, does that help you understand the creation of what you asked, the liquidity?
Yes, thank you so much. It was amazing. Thank you. I understood.
Okay, and the same can be said over here. There is actually a order block sitting here that has not
There's
been tested.
also
And
and there's also this liquidity voids in those areas. Will that be taken care of in later stage?
oh, definitely. If you look over here on the weekly chart, look at this liquidity that's or imbalance in price over here that still has to be raided. So I actually saw this about a month or two ago, but that still needs to be taken at some point. You can see that this liquidity here, this imbalance in price, was closed. So there was imbalance in price, retail traders buying, more liquidity over here, imbalance in price, order block at the bottom. Price closed these two fair value gaps or liquidity voids because it's a weekly chart. Came down, tested our order block, and boom, price bounced off. This is not random. Price is not random. It's algorithmically generated. There is an algorithm that generates price, which will be covered in another video, which is called the IPDA, which is the Interbank Price Delivery Algorithm. It's a very complex inner working of the system, but that is how price is delivered to us retail traders through this IPDA. So that is something I will touch on in the future, but it's a very long explanation, so I'll need a whole video to explain it. Okay. But yes, you can see that liquidity is still sitting there. So we can expect reaction off that zone when price comes there. Why? Because there is an order block over here on the weekly chart, daily chart. You can see that inside of that order block over there, this fair value gap was closed as well. So there was another fair value gap over here. If we zoom in, that fair value gap over here was closed by this wick of this candle, closed that imbalance in price and created an order block. Boom. Encapsulating all of the orders that tested it. So price rallied up, tested again, price rallied up, tested again, price came, tested, rallied up. Order block has not been broken, so it remains valid until price closes below the order block. Okay. Benson, you have a question?
Yeah.
Thank you.
I have a question, Darren. Thank you. My question is, now we've been able to identify these soft area and an area of liquidity and stuff like that. So I want to get how then, what then is the possible way to make entry and trade, because definitely it's obvious we are the mercy of the market maker. So what's the best way to make entry?
Well, you basically do what there is one thing that retail teaches you, and that is a top-down analysis, which the same can be said for trading institutional concepts. So I'm just going to show you an actual trade that I took on EJ, and I can tell you why I took it. So if we look at EJ, and let's just start from the top-down analysis of the daily chart. Okay, so this is Euro JPY, and you can see that price rallied up into this level over here. Okay, now why did price rally into that level? Well, if you look at the daily chart, so let's just go across over here, and we can see that there is actually an imbalance in price over here. So let's just zoom in there. You can see that there is a large imbalance in price over here. Okay, so that whole area is imbalanced. Even though that there is wicks inside there, there needs to be, because this is a daily chart, there needs to be some fill of balance in the daily chart. Okay, so I'm just going to mark this up and take it as a purple, and let's now pull that across to where price came to. Boom, right there. So price is not random. It is, if you're looking and you can learn everything I'm teaching you, you will see these things based on a top-down analysis. So let's just go back to there. So we've marked up now our fair value gap, or actually it's a liquidity void because it's a daily chart. So when price came there, what is there? Okay, so not only is now there's a fair value gap, okay, there is also a, let's see, institutional price level of 500 that was respected. Boom, like that. Let's just remove that red line here. So you can see that that is the institutional price level. Okay, this is a daily chart. I've marked up an imbalance in price. Let's just see if there's anything else for us at that level. Yes, there is. There is actually an order block over there at that level, right there. So I'm going to make that blue so we know that that's a daily order block, like that. Okay, so there's our daily order block, just like that. So there's our daily order block and our imbalance in price. And now we've marked up on the daily. Let's go to the 4 hour. And we can see that price reacted, rejected our 500 institutional level, okay, because we had followed the order flow coming from the bottom to the top, okay? So we're following the order flow and we are looking for a reaction at this level because we trade price action. So we just follow the trend until we see some reaction on a higher time frame. So this is our higher time frame markup of the fair value gap or liquidity void and our daily order block. Okay, so when price gets to this level on the 4 hour, we expect to see reaction. We see a reaction on the 124,500 institutional level. Okay, so this order block over here, a bullish order block, even though it's not a very strong order block, it's still an order block over here. That is an order block over there. So it was responsible for the push up into here. Okay, but that is not a strong order block. So our strong order block for the last move to the upside would have been this order block over here. Okay, so when price rallied up, it rallied off this order block, pushing price up, created another order block over there, pushed price back up. Okay, and we can actually see now that a bearish order block was created over here. Okay, so there is our bearish order block created and then pushed price down. Okay, now we can see that we had expected a reaction because we had a daily order block, we had a fill of our imbalance in price and a reaction of our institutional price level. Then price traded sideways or accumulated orders or compressed or whatever you want to call it, consolidation. There's many terms for it, but price traded inside that zone. And if we look closer here, price created this order block over there. So that bearish order block was responsible for this move to the downside. Okay, so there's actually now also a fair value gap that was created over here. This is now a fair value gap over there. So we can expect price.
So there's a possibility of price going up there.
Exactly. And here is our break in structure because this candle over here closed below our strong order block. So this here becomes our breaker. So that is our breaker. Price closed below, came in, tested our breaker. Here is our fair value gap that has not been filled. So at some point this will be filled because there is imbalance in price, and price likes to balance. So there is a fill, okay? But as we see now, that price is now forming bearish order blocks, okay? So here is a bearish order block responsible for this move to the downside. Price rallied up into the order block, did not close above the order block. Notice also that if you listen to what I say on my previous videos, you can either take an entry on the 50% of the order block or the opening of the order block. So there was two potential entries here if you were following the flow of the orders on EJ, and you could have either taken another entry or this could have been your first entry, and that is now we're following the order flow. So you don't just take a trade at the bottom here because we see a break. That's not the way we teach. We teach to wait for price to come in to test the order block, having a limit or waiting for execution. We take the order and then we take it into the trade and then we begin the ride down. Okay, so we can see that multiple order blocks was formed over here. Another order block over here was created over here on this candle. And you can see price retested the order block and went down. So even if you got in here, because there was multiple times that you could have, even if you got in, say, at this order block over here, rode the wave down, you already would have caught 160 plus pip move on that order with a very small stop loss. If you put it just above that high, I would have traded with a 30 pip stop loss. So there would have been my stop loss just above that high of that order block, because now there's two order blocks. So when they intersect, it will like each other. We can expect some form of move to the downside. And you can see again, price came up to retest the order block and bounce back down. So even if you had entered here, could have caught another move, 70 pips. So there's multiple times where you can enter on either the 4 hour, the D1. Let's just take a look here. This is EJ. So you could have even gone down to the 1 hour. And let's just take a look at price reaction off those levels. So here we know that our price reaction is at our daily order block, our institutional level of 500. Imbalance in price is filled. Notice also we have a 1 hour order block. So let's just make that order block pink. So that order block over there, 1 hour, boom, another order block, 1 hour, boom, another order block, 1 hour. Notice how each time you could have got an entry either off the opening candle, that specific one off the opening, but this one you could have got off the 50% level, or even the opening of the candle. And again, the opening of the candle here is the 50% of this order block, and you could have been filled even there. So if you are using a top-down time frame from D1, H4, H1, M30, M15, you will just build on your experience by doing a view from the top to the view from the bottom. And the lower the time frame you go, the better entry you can get. You can even get a 10, 20 pip, 30 pip stop loss. I mean, some people trade with 50 plus pips. I don't do that unless I'm swinging and I expect to hold the trade for weeks. But when you're trading, you know, in the course of a week or intraday, you don't want to take trades with 30 pip stop loss, because you would rather want to take trades based on your size of your account. So if we look at $1,000, for instance, that's what most people trade with. If you're trading with a 1% risk and you got a, say, 50 pip stop loss on $1,000 with 1%, you can take a lot size of 0.02. But if you can reduce your stop loss to, say, 30 pips and still take a 1% risk, you can take a 0.03. The smaller your stop loss, say 20 pips, you can get a 0.50 lot size, still risking 1%. So risk reward is what is important in what I teach. Anthony, you have a question?
Yeah.
Yes.
Hello, can you hear me?
I can.
Okay, thank you very much. I really love your techniques and your analysis. How much does this techniques go with the COT reports?
Okay, so the COT reports is basically a week after what happened. So you will expect the COT reports, I think it comes out every Friday, which will tell you the sentiment of where institutional orders lay for the given week. So in the past. So you as the retail will only receive that report, say Monday or Sunday, and it's already too late to make a decision. So although you can use the COT report, the COT report is in hindsight of what has already happened. So say the COT report, you receive it, say you get it tomorrow as an example, and it will tell you that the net bias on say GBP USD is net long, okay? But we've already seen that there's reaction for GU to potentially go to the downside. Now, that is a delayed reaction in the COT report. So the COT report can only give you a certain level of confluence, if you will, to make a decision on your trade. But it is based on hindsight. We trade price action, which is live data in real time. So any reports or broker sentiment you use, so if you go to the likes of certain websites, they will show you sentiment for any given pair. I can actually just show you that here. So if we go to, for instance, my FX booker here, right, and we look at the sentiment for any pair, okay, it's the same. It's looking in hindsight. Look at the outlook, right? So the outlook now is changed, okay? But this is not an indication, oh, okay, this U chef is in a buy because the long percentage of traders is 58% and the shorts is only 42%. That doesn't mean now you must go long because this is telling you that it's most of the traders are in long. That's irrelevant. It is how banks move price. It is not, this is an outlook of broker data, and it's an amalgamation of various broker data. Brokers don't control price, institutions control price. Liquidity providers are the people who provide liquidity to brokers. So you get institutions, you get liquidity providers, and then you get your brokers, and then you get us retail traders. So we are at the short end of the stick. Does that answer your question? Sorry if it's very long.
Okay, thank you very much. God bless.
Anyone else have a question? We're going to have about 5 minutes left of this session. So if anyone has a question.
Hello, I have a question, Mr. Darren.
Yeah, Manuel.
I want to ask, I've watched the order block video repeatedly, and I discovered that order blocks intersect even in different time frames.
Oh, of course,
when you have daily, it can intersect with the H4 and the H1 too. Definitely. So I want to know if you can take trades based on that, just that alone?
Oh, of course, yes. So like you've watched the YouTube videos, I show you that order blocks, when they are untested or unbroken, they remain valid. So only when they are broken, then they become violated. So like I showed you with Euro JPY over here, where we did the top-down analysis of the daily chart, multiple time frames can intersect with lower time frames. Okay, so let's just look at another trade I took, which was NU. And if we look at NU on the 4-hour chart, right? So over here is a daily, a 4-hour order block, right? So there is a 4-hour order block. Now let's go down to the 1 hour. So in the 1 hour order block, 4-hour order block in the 1 hour time frame, we will see multiple other order blocks formed. So here is a 1 hour order block over here, formed inside of the, so I'm just going to make that pink. So this is red box indicates a 4-hour order block, and the pink box indicates a 1 hour order block. Okay, so now let's go down to the 30-minute. Inside the 1 hour order block is another order block of a 30-minute. So let's just make that a green order block. Okay, so do you see what I'm doing here? I'm just going from time frame to time frame.
Sure.
And you can notice on other small time frames, other confirmations for trade. Look here, this is a fair value gap on the 15-minute chart. Fair value gap.
Wow.
Let's look, if we pull this across here, that fair value gap was closed. So say, for instance, you did what I just showed you here, and you placed your order at the, say, the green box indicates a 30-minute order block. Here is the 50% of that order block, and you enter, say, execution or sell limit, and you put your stop above. Look how tight that stop loss is, even if you make
Wow.
it 15 pips. So yes, order blocks appear on multiple time frames, and the more intersection they have, the higher the confirmation. So everything I've been teaching is confluence with each other. They can each be used on their own or added all together is best. So like I say, I normally only take trades where you have 5 minimum confirmations, and that's order blocks on multiple time frames, fair value gaps, equal highs, liquidity being raided, institutional price levels. Notice also there's an institutional price level over here of 800. So again, you have another confirmation that price is going to be respected. So not only do you have a 4-hour order block, a 1-hour order block, a 30-minute order block, and an institutional price level, and a 15-minute fair value gap to be closed. So even if you take the fact that the fair value gap will be closed and you enter the trade not at the 50% of the 30-minute order block, you will take a trade on the close of the fair value gap and you put your stop above, that is still only plus spread. So let's make it 18 pips. That is, I'm sure, much greater than any trade you've taken ever in the previous past, because you were accustomed to the fact that you put your stop above the support or resistance or below, and that is how you trade from support to resistance and resistance to support. That does not exist. Banks and institutions, governments, countries control the flow of price.
Exactly.
Anyone else have a question? No more questions. Okay, well, it was a very important topic that you brought up. Thanks for that, Emmanuel, because some may not have known that. So now that it is recorded, I'm sure others will find great value in that. I'll see to try have another midweek Zoom call for you guys.
Thank you very much, Jack.
No one else got a question before the last few minutes of the call? Matesh, you've always got something to add.
Hi, Darren, can you hear me?
Yeah?
Okay, no, actually, refer to your group chat. There's someone that did ask a question there. No, sorry, not group chat, your Zoom chat.
Hi, Darren. I'd like to know if all of the new reports from various countries have an effect on the charts before being released. For example, if NFP comes out positive, will the report affect the chart at the current moment, or would it have had an effect on the chart before being released? So, like I said, sorry if I say your name wrong, Everleast. Like I say, that fundamentals are an inducing gimmick to induce retail traders into trading news. So if you've ever noticed on any broker that you're with, you'll get news or an email to say, oh, trade NFP in 24 hours. Is the USD going to fall? Is it going to bar? What's going to happen with the jobs report? Is it going to be a consensus or an actual? Is it going to be worse than expected, better than expected? All garbage. The fact of the matter is the banks, the institutions, the hedge funds, the governments, the countries, the companies that sell and buy currency have already done what they needed to do before the NFP data comes